Hello and welcome to this Tolley Seminars Online lecture where I'm going to be talking through the changes relating to personal tax that the Chancellor announced in his budget this Wednesday. My name is Chris Jones, Director of Tax Markets and Learning Solutions at Tolley. The Chancellor announced the income tax rates and bands for the tax year which is about to commence on the 6th of April 2013. Now let's just remind ourselves, of course, that previous announcements a year ago has cut by 5% the additional rates of tax applicable to the top earners. The general 50% rate of tax that applies to incomes above £150,000 reduces to 45% with effect from 6th of April, and the dividend rate also falls from 42.5% to 37.5%. However, of course, when we compute the amount of tax applicable to dividend income, we generally refer to it based on the percentage of the net dividend. And we're seeing here a fall of 5.55% as opposed to just the 5%, from 36.11% based on a 42.5% additional rate to 30.56% based on the 37.5%. So a good level of reduction of tax applicable to top earners, and of course this has not been without its political controversies. Now the higher rate threshold, the point at which the 40% rate of tax applies, will reduce from the 6th of April 2013 to £41,450 from the current level in 2012-13 of £42,475. Now the impact of this reduction is that for the general higher rate taxpayer, the additional tax applicable will be £62 in tax year 2013-14 compared with 2012-13. In addition, it also brings in another 400,000 more taxpayers into the higher rate regime and therefore potentially increases the number of individuals applicable under self-assessment by a higher level. So therefore there's going to be more clients around for us to do tax returns for. Now the Chancellor does assure us that this continuing trend to increase the personal allowance and reduce the high rate threshold will start to reverse in future years. He's already announced that the high rate threshold for 2014-15 will cut in at incomes of 41,865, and for the year later, based on the current increase in CPI, will be 42,285. But that will not bring us back to the level that we enjoy in 2012-13 of 42,475 until after the next election. Now the Chancellor has also announced some changes to personal tax allowances, and you may recall in the autumn statement told us that the personal allowance will increase to £9,440 from the previous announcement a year ago where he told us it would rise to £9,205. Now the magic 10,000 limit, which the coalition government wants to get to, will come in from 2014-15 for those born after the 5th of April 1948, and that will apply from 2014-15, a year earlier than the Chancellor previously announced. Age-related allowances are frozen at the 2012-13 rates and currently are only available to those born on or before the 5th of April 1948. Now many of you will recall the 10p tax debacle that Gordon Brown inflicted on society a few years ago, where previously we actually had an alignment of the personal tax allowance and the national insurance threshold. Of course, his solution to address the 10p tax debacle was to increase the personal allowance for tax, but not for national insurance. And we are therefore still at a level where we start to pay national insurance before we pay tax. For tax year 2013-14, the national insurance threshold cuts in at incomes of £7,755. The Chancellor has also taken the liberty to increase the annual exemption for capital gains tax in line with the rise in the Consumer Price Index, taking us to a new level of £10,900, but has chosen to freeze the inheritance tax nil band at the current £325,000 limit, and you'll see shortly the reason behind doing this. It is to fund something else. Now let's turn our attention now to the seed enterprise investment scheme changes. Now this is more sort of colloquially known as the friends and family relief, where you invest in a very small company, a very small start-up company. Normally will be run by people that you generally know, but the problem with that is that the relief for income tax is not available to you if you are an associate of the owner of the company, and of course we're looking at associates there being your close relatives, your children, your grandchildren, your brothers and sisters, or indeed your parents. Now the Chancellor announced the seed EIS a year ago, but has made a tweak to the rules this year. Now what the Chancellor has done in the budget is to announce that the CGT exemption that applies where we sell an asset and use that money to reinvest into an SEIS eligible company, now the gain would normally be exempt, and the Chancellor has now told us that only half the gain will be exempt for any investments we make into next tax year, but on the plus side has given us 2 years to find the reinvestment rather than the previous 1 year, in the fact that the reinvestment extends to investments made in 2013-14 or 2014-15. So a bit of good news, a bit of bad news. The Chancellor has also taken the opportunity to address an anomaly which was introduced in the original legislation, which prevented us getting SEIS relief for companies that we purchase off the shelf, which apparently was a drafting error which HMRC latched onto. The Chancellor has corrected that drafting error to allow us to invest in off-the-shelf companies and the relief still being available. Now the good news, of course, about SEIS is the fact that income tax relief is available at 50%, provided we have the tax capacity in the year of investment. And you'll recall that the maximum amount that an individual can invest in the SEIS in a year is £100,000, assuming then that your tax liability in the year is at least £50,000, you will have that tax capacity. Now what I'd like to do in the next couple of slides is just to talk you through the impact of these SEIS changes to the calculations that we previously shared with you. So let us assume that an individual invests the maximum amount he can in a tax year of £100,000 into SEIS. He'll reduce his tax liability, his income tax liability, by £50,000. Under the previous pre-budget rules, if he reinvested the amount of a capital gain he made on disposal of another asset, for example a buy-to-let property, he could actually exempt that gain, which would otherwise be chargeable at 28%, actually exempting £28,000 worth of CGT. Now, assuming the worst happens, the business fails, then basically the taxpayer will be eligible to make a claim under what is now Section 131 of ITOIA 2005 and can convert what would normally be a capital loss into an income loss. And let us say that the individual is an additional rate taxpayer liable at 45% into tax year 2013-14. That means that he'll have a loss of £50,000, the £100,000 he invested, less the income tax relief that he was able to secure. Not the capital gains tax, that's completely ring-fenced, so the loss is £50,000 at 45%. If you actually now add up the amount of tax relief the taxpayer has now had on the £100,000 investment, it actually comes to £100,000 and £500. In other words, he'll actually get a return of £500 for that investment, even if it goes belly up. If, of course, the investment grows, he'll actually be able to take advantage of the growth of that investment free of CGT. So great news, complete no risk to the investor under the pre-budget rules. And even if you're a 40% taxpayer, it will only cost you £2,000 to put at risk £100,000. So at the end of the day, you get £98,000 worth of tax relief, as long as you can take advantage of the £28,000 worth of CGT relief. Now the rules that apply after the budget, whereby only 50% of your gain is exempt, does change things considerably. So you invest your £100,000, you get your £50,000 off your income tax bill, but your CGT exemption will now only be worth £14,000. Your ability to claim a capital loss against your income will remain, and a 45% taxpayer, again, that's £22,500. But the net cost to the investor now will be £13,500 for an additional rate taxpayer, or £16,000 for a 40% taxpayer. Because, of course, you'll actually have £14,000 worth of CGT to pay, which you didn't under the pre-budget rules. So we must now bear in mind the relief, although it's still very generous, it's not quite as generous as it was before last Wednesday. Let's turn to some new provisions that the Chancellor is introducing. A new social enterprises investment tax relief to encourage private investment in social enterprises. The Chancellor is looking to introduce something in next year's finance bill, with consultation this summer on what those proposals could look like. Let us turn our attention now to something we ought to be looking at doing pretty quick now, and that is the trust rate of income tax. So trust rates reduce by 5% from next April, from 50 to 45% for general income, and from 42.5% to 37.5% in respect of dividends, and therefore the tax credits attaching to those distributions will also reduce by 5%. Therefore, if there is any undistributed income in the trust which is covered by the tax pool, it will be advantageous to distribute that income before the 5th of April this year. So some action to do in the next few days for those appropriate trusts where you do have some income tax in the tax pool and undistributed income. Turning now to non-domiciled spouses and civil partners. You'll be aware that there is a limit of inter-spouse transfers that can be made to a non-UK domiciled spouse from a UK domiciled spouse. Now, the limit has always up until now been £55,000, which is very low. That is now going to increase dramatically to the level of the nil rate band of £325,000 applicable from the 6th of April 2013. There is no limit, as you'll always be aware, for any transfers to a UK domiciled spouse, because of course a UK domiciled spouse is liable to IHT on their worldwide assets, and therefore there's currently no limit whatsoever if it's to a UK domiciled spouse, even from a non-UK domiciled spouse. The Chancellor is also introducing a new election which will enable, for inheritance tax purposes only, a non-domiciled spouse to be treated as though they are UK domiciled, which will bring, of course, a liability to IHT on their worldwide assets, but will actually remove any limit at all on the level of exempt inter-spouse transfers. This will be advantageous, of course, to any non-dom spouse where they have very little foreign assets to be brought back into charge, because of course it will give greater scope to transfer assets between husband and wife. This election must be made in writing. There will be a provision to backdate it for up to 7 years, but not before the 6th of April 2013. But once made, it will be an irrevocable election. There's also provision to allow the election to be made by personal representatives for a deceased non-dom spouse within 2 years of death, but again provided that death occurs any time from the 6th of April 2013. Now, another nasty IHT change that the Chancellor has introduced, which we were not aware of before the budget, is around inheritance tax for business owners. Now, the current sort of planning here is that where we actually buy, say, a business asset and we secure the loan against, say, our personal home, it's very advantageous for tax because, of course, let's say that the business asset itself, whether it's shares in a company or some plant and equipment, etc., that will likely be covered by 100% BPR, but because under current rules the loan is secured against a home, then the loan can be deducted from the value of the home, which is fully chargeable to IHT. However, from royal assent of this year's Finance Act, all that changes in the fact that you cannot deduct the value of the loan from the value of the home. You have to deduct the value of the loan from the asset from what it was used to buy, which will of course be the business asset, which is already covered by BPR. And that will mean, of course, that a significant increase in IHT liabilities will apply. Now, the point worth making here is that for IHT purposes, it's generally a good idea to secure your loan against your home, but the problem with that is if the business fails, you could lose your home, but it's obviously good IHT planning. Once we get to royal assent, you may be better off actually securing your loans against your business, so that at least then if the business failed, you lose the business but no other private investment asset or your home. Because of course there's no IHT advantage in doing it any other way in the future. You may as well protect your assets as best you can. Now let's turn to care in old age. Currently, for those with savings in excess of £23,000, they will be required to contribute to the costs of their care if they require care in their old age. This limit is due to rise to £118,000 in due course, but there's new rules that are going to be coming in from after the next general election. From April 2016, the plan is that there will be a maximum cap on the amount that any individual will be required to contribute to their care, and that will be £72,000. And this, the Chancellor is funding through a cap in the increase in the IHT nil band. And this therefore provides us with some greater certainty when we're doing estate planning for elderly clients who are concerned that they need to leave enough money in their estate to look after them in old age. Obviously £72,000 will be the cap. That will obviously gradually go up over time. Turning now to our final point on vulnerable beneficiaries. Now, vulnerable beneficiaries are defined as disabled persons or those under 25 who have lost one or more of their parents. The broad aim of the changes will be to allow the lower of £3,000 or 3% of trust assets to be applied to non-vulnerable beneficiaries, for example, to provide a car or a shared holiday for carers who may or may not be family members. Now, currently, all of trust assets need to be applied to vulnerable beneficiaries, but they are allowing a small amount to be applied to non-vulnerable beneficiaries without breaching the rules of the vulnerable beneficiary trusts, something that you may wish to look into for a handful of your clients. Well, many thanks for listening to this lecture on the Personal Tax Changes of Budget 2013. My name is Chris Jones, Director of Tax Markets and Learning Solutions at Tolley.